Hey, good afternoon, everybody. Thank you for joining us today for this Small Business Bootcamp Lunch and Learn. I'm Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services at the Arizona Commerce Authority, and we're excited to have you with us today, and I'm glad to be your host. One of the things we like to do as we start out our webinars is we like to see where everybody is tuning in from. So if you could post in the chat where you are tuning in from, we just like to see where throughout the state everybody is from, or sometimes beyond the state borders in other states. So I see we've got Gilbert. Thank you, Heidi. We got Michelle from Tucson. North Phoenix. Thank you, Stan. All right, we got Anna from Albuquerque. All righty. Well, again, if you're just joining, please post up in the chat where you're tuning in from, but we're going to go ahead and jump right in for today's Lunch and Learn. All right, San Manuel, Arizona. Ricky, I did a motorcycle race out there once. It was awesome. Wonderful trails in San Manuel. All righty. So one of the things we like to do as we start these is we like to thank all of our community partners that help with our boot camps and our lunch and learns and our other webinars. We could not do these webinars, this education without them, without their time, their effort, and their expertise. They're all giving back of their time to help small business owners learn a little bit more about how to run their business better, or in this case, why you want to run it efficiently so you can have maximize your business value. And this is just a sample of the 200 plus partners that we've had participate in the boot camps over the last 4.5 years. So if those that are new to the boot camp are tuned in for the first time, the Small Business Boot Camp is designed to help small businesses prepare, plan, and grow. And it is our weekly webinar series we host every Tuesday morning. And then we do some occasional in-person workshops and virtual workshops such as today's Lunch and Learn. We also record all of our virtual sessions, and those can be found in our content library where we have well over 300 recorded webinars and workshops. And there's no cost to access those. You can just click on the session and watch the video or download the slide deck from the sessions. The Arizona Commerce Authority also has a number of programs to help support business and small business in Arizona, whether it's manufacturing, small business, entrepreneurship, and tech businesses. You can be in rural or looking to export. We have some talent and some tax stuff. You can find all that information at azcommerce.com/programs, or you can just scan the QR code on the screen and it will take you to that web page. One of the programs we always like to talk about with our businesses is our small business checklist. This is an online interactive tool that helps small business owners that are looking to start or expand or scale their business to identify the licensing, registration, and compliance requirements at the local, state, and federal level, along with other things such as business planning or procurement, marketing opportunities, and many more. It's a very in-depth checklist with a ton of information that can sometimes seem overwhelming. But to help with that, we have our virtual assistant, Sally. Sally stands for state and local licensing information. And you can leverage Sally's AI to help you find that information as well. So real quick, a few of the upcoming Tuesday webinars that we have going on through the rest of this month and into February. A lot of marketing related ones in this session. They're all going to be pretty awesome. We've got great presenters for them, so hopefully you can join us from 9 to 10 a.m. on Tuesday mornings. If you can't, we do have these will be recorded and you can watch them in the content library. But with that, we're going to jump into today's session, and we've got two great speakers. We've got Diane Shumway, financial advisor with Sagent, and Ron Elwood, the president and CEO of CRO for My Business. And so we're glad to have them with us. And with that, I'm going to go ahead and stop sharing my screen while Ron pulls up his. And while he's doing that, we want to remind everybody, please post your questions in the Q&A at the bottom of your screen. So we can save the chat for any interaction we may have. That way the questions won't get lost. Sometimes if there's a lot of interaction in the chat, the questions get, pushed up and then they get missed. So we like to use the Q&A box so we can answer any questions that you may have. So with that, Ron, it is all yours.
Well, thank you. Thank you for joining us today. We appreciate you taking the time. I am Ron Elwood. It's a CFO for my business is our business. Fractional CFOs. I am a CPA, but I don't spend a lot of time advertising that anymore because our practice takes on a little different color than a traditional CPA practice. We do some tax compliance and planning, but the focus of our practice is on finding those drivers of value and profitability in our clients and helping them capitalize on that for future value growth. And I've been doing this for about 20 years. I spent time as a CFO and the president and CEO of some other entities and realized that particularly in the Arizona market, most businesses are small to medium sized. They lack some expertise in the financial CFO area, and so we provide those services on an as-needed basis.
Hi, my name is Diane Shumway, and I work for Sagent. We're located in Southern California. My office is in Beverly Hills, and I think you may have heard a little bit about Southern California lately. It's really tragic and unfortunate, but thankfully, some of our agents have been on high alert or displaced temporarily, but no one has been devastated so far. You might wonder why I would be presenting because I'm in California, but I want to assure you that my heart is in Arizona. I was born and raised in Arizona. I went to Cortez High, and I was a proud artichoke at Scottsdale Community College, where I played volleyball and we won nationals. So I love Arizona, and I love what I'm doing because I am financial advisor focusing on helping business owners understand their capacity and building their wealth through their business. And I work closely with Ron because he helps hone in on your business where I help build your wealth. So this is where we start. Hopefully we can come back, but this is basically the fundamentals. This is the foundational work. A little brief disclosure. Neither one of us can give you legal advice, but Ron can actually give you tax advice. I can't. So here you go. Now to start off. It is important to understand the foundation of a sound business and personal transition strategy because it is where you start your comprehensive business planning. Visualize it like constructing a piece of architecture. Start with the foundation, and this is where Ron would help, which is knowing the value of your business. If your business is key to your financial future, assessing its value is a critical step. Establishing the 3 support pillars, succession planning, retirement planning, estate planning. These pillars provide the necessary support for your transition. Ensuring that these areas are addressed clearly, communicated, and documented is so important. The ultimate goal of all of your hard work is to know when you can exit and when you can, and hopefully do it on your own terms. Okay.
Go ahead.
The common roadblocks that impact why people don't take a look at their foundation, their value, is they don't feel like they need to understand it. They're too busy in the day-to-day management of the business. They don't think they have enough money, and they don't know where to get their help, which you're on here. So now you know. And it's an uncomfortable conversation with your family and your business partners. Now, common motivators to understand your value is you want to protect your family, you want to protect your business. You're doing personal planning and it prompts you to do business planning, and you want to protect your employees, and a trusted friend like Robert and Faith have told you, this is important aspect of the business.
So as we move on, it's important that we reiterate that knowing your options and evaluating all of them as exit options are important. A lot of the business owners that I come across just simply believe that the day they're ready to retire, they'll put their business up for sale and they'll have a buyer and they'll move on. But that's just not necessarily reality. Of finding someone that's willing, able, and ready to pay your price. In fact, about 80% of businesses that are put up for sale don't sell, and then even a smaller percentage sell for something less than what the owner thought the value was. So, if a business isn't ready to sell, it's also not ready to transition. So, what we encourage is that people focus on being a value accelerator. And that is a business owner who's focused on the true drivers of their value and focuses there to help ensure that the exit from the business is on your terms when the time comes. So it's important to point out a 2022 Mass Mutual owner study said that 10% of businesses say they don't ever plan to exit. It's interesting because there is one thing that's ensured is that 100% of us will eventually exit our business, either by design or default. We will exit. And much of the feelings of not wanting to exit are tied up in an owner's identity, that their business is an extension of them, and preparing to leave the business is difficult for them. And so the sooner you start to prepare and to focus on those things, the better the transition might be. There's an interesting struggle that most business owners have between it's my baby and it's my lifestyle. It leads, some of them to never truly leaving a business. When they are asked why they don't leave a business, 3/4 of them say it's because they still enjoy running the company and no one can run it like me, which is, it's my baby. There are others say that they can't leave because of the financial security, it's my lifestyle. 60% believe they will have to adjust their lifestyle when they leave their business. And so the reality is that business owners are reticent to exit, most likely somewhere in between these two motivations, which, early planning and focus can help alleviate those and really create a lasting value in a business. There's if we look at it and sort of boil it down into two subsets of mindsets, there's a lifestyle business owner and a value creator. Lifestyle owner is just really comfortable with the state of the business as long as it's supporting their lifestyle and the income that they need today. They don't focus much on the future of what the needs might be, the changing environment of the business, or what it will look like when they're ready to leave. A value creator is an owner that prioritizes growing the enterprise value over the income. It takes the necessary steps to maximize that value over time while they're still running the business. An enterprise value, just to note, is it looks at the business through the lens of its operational and financial performance, which helps to understand why what's driving the value, and so the improvements to the business can be made to increase that value. And so, as a business owner, you must adopt a mentality that the expectation is the business sale will fund the majority of your retirement. then we must focus on growing the value, not just the income. Because we often tend to adjust our lifestyle upward as our income goes upward. And so if we need to plan for those eventualities at the end. So knowing the true value through business is important. According to a Mass Mutual study of business owners, knowing the business worth is very much in the top of the mind, with 61% for saying it's important. The reasons given for wanting to know the value tend to focus more on business key performance indicators rather than strategies to protect business and its wealth it generates. Some business owners believe that they only need to know value when they sell. In addition, many owners value their business themselves. And this is always an emotional decision, and it is, for the most part, not correct. Proper business valuation is not a rule of thumb figure or agreed on a handshake. You know, at the basis of it, the value is defined as what a willing buyer is willing to pay a willing seller, but getting to that, understanding it and driving it is sort of what we're talking about today. So it's important to find someone that is a credentialed valuation specialist, and there are various different organizations out there that give credentials. There's a CVA, which is a certified valuation analyst, accredited valuation analysts, and accredited senior appraisers, and then accredited business valuation specialists. And so it's important to find someone that understands and can look at those things so that you have a clear understanding of what the business would be worth. So knowing a true business value is difficult. Owners typically misjudge the value of their company by as much as 60%. We often see this. We'll talk to people and they'll either believe their business has no value or it's worth $100 million. And so understanding really what that is over time is very beneficial to you. Because if you don't, you can set yourself up for pitfall or shortfalls of income in retirement. Like I said, a business owner's valuation is really nothing more than an emotional gut feel of what they want it to be worth, as opposed to what it really is worth. And second, it's really difficult for business owners to gauge those intangible assets, which account for as much as 80% of the value in a business. You'll hear a lot of people talk about valuing your business just using a multiple of EBITDA, and you'll use a 4 multiple. The factors that go into that multiple are the things that we're talking about in this 4 capital. 4 capitals. There's human capital, which is the management and the employees, talent, our customer base. The second one is customer loyalty, recurring revenues. Structural capital is patents, trademarks, process documentation, and our social capital would be brand, reputation, and community engagement. And those are hard to value, especially from a business owner perspective. And those things are what drive that multiple. So when it comes to valuation, there are multiple different techniques that can be used, or valuation calculations, and they kind of fall into a couple of different categories. There's these can be put into sort of 3 different categories: asset, market, and earnings. An asset-based valuation simply looks at a going concern, takes the value of the assets, subtracts the liabilities, and that's the value of the business, that we also typically referred to as book value. And then there's another asset valuation method, is the liquidation value. What could we sell the assets for, pay the debts, and the leftover would be what the owner would have to work with. The market approach attempts to to value comparing to similar business sales, similar to what you would do in a real estate sale where you get comparables and then look at the property you're selling and come up with a value that way. This method only works if there are significant number of sufficient number of business sales to compare to, and that's not often the case. The earnings value approach is based on the idea that the business value lies in a business's ability to create wealth in the future. So capitalizing past earnings and determining an expected level of cash flow for the company using the company's past records and then normalizing them for unusual revenues or expenses and multiply out to normalize cash flow. When we talk about normalizing, many small businesses have, additional perks to the owners, cars, rent and some other things. And so we normalize those out. The other capitalization or earnings based is to look at the future earning potential projections and then discount them back to today using a discounted cash flows method to come up with a method of valuing the entity. And so typically the ones that we see are these earnings methods because they're the most favorable to the seller of the business. So why is it important to know the true value of the business? Selling our business really paves the way for a future financial or secure financial future, and knowing its value is critical. If it's based on a foundation upon which sound business is built, then we're more successful. When that foundation is weak, because of an inaccurate valuation, it can lead to issues such as an underfunded buy-sell or retirement income shortfalls, lack of liquidity in your estate, the ability, inequality of distributions of assets out of the estates, and then disagreements among heirs of your estate. So how do we focus on value growth? According to the MassMutual Business Owners Perspective Study, where a business is heading in terms of value is just as important as where the value is today. In fact, half of business owners have a future valuation done in their companies and believe it will grow in value in the future. An interesting thing about future value growth is the reasons why owners are curious. The reasons are different than why they get a current valuation. So current valuation is done for reasons of gauging health in the business, to know what I can get in a sale or apply for. We often see, applying for lines of credit or things of that nature. In the future, if they're looking at the future, the reasons for valuing is to know the growth potential, and then for any estate or future tax obligations, and then if there is sufficient value to fund retirement. Most small business owners, state that their business is their retirement, and so if the value isn't there, then there's a shortfall that has to be looked at. There's some other interesting things that need to be looked at that are milestones. If a business has more than one shareholder, then there's the notion of a buy-sell agreement and how to value for that, and whether it's has provisions for retirement or disability or death, and vague buy-sell agreements. We see a lot of buy-sell agreements that simply list a formula, or they simply say we're going to hire an independent valuator, and that's the value we use. You have to be careful with that. I had a client a number of years ago that two 50-50 partners in the business, and one died suddenly, and the buy-sell agreement had a clause that said the survivor will hire a valuation firm to value the business, and that will be the the value of the business. Well, at the time of his death, the business had experienced a little bit of a downturn. It was struggling a little bit, had with a negative cash flow. So the valuation firm valued it at zero. And so the funded life insurance paid the surviving partner, and he was not required to pay the family of the deceased partner. And so they walked away with nothing. So you have to be careful that how they're worded. Another thing to look at is, the retirement, retirement planning assumes greater importance as, we typically kind of see people at 50 or 60, 50 to 60 range start to see their friends retiring, and they start to think about, one day retiring. And so value becomes an important piece of that. And then certainly when people are ready to leave, it comes, they really need to know the value at that point, but often that's a little late. So we encourage, sooner than later, and certainly value is important to estate planning. And this really came into focus the last few years. The Trump tax provisions from 2018 increased the estate exemption to roughly $23 million from married filing joint of estate assets that would be exempt from estate tax. That was is still slated to expire at the end of 2026, and it goes all the way down to about 6 million. So it really came into focus, and I would anticipate that the results of the election would change that, but right now it is the current law that will reduce at the end of 2026. So, you have to be prepared for kind of knowing in the future what your estate might be worth. So when we focus on maximizing value, according to the Exit Planning Institute, 2/3 of business owners say getting full value is their top exit goal. But how do we achieve that? Well, it starts with understanding what drives value in a business. There are roughly 18 business value drivers, and half are operational driven, and often in the control of the owner, and the other half are market driven and generally external to the business. So if you make a determination that you want to embark on a strategy to grow the value of your business, these are the key areas that you would want to look at. In addition, potential acquirers of the business would rate these values differently. And so, we kind of have to understand that's a little bit of the market piece. So the drivers in the left-hand column, the values of your business, if they exist and are best in class for your given industry. For example, existence of recurring revenue models, or the fact that there is a difficult entry point into your market can make your business more attractive to acquirers. Recurring revenue is a real key driver. You have to have a history of that, and especially if you have customers that are recurring or that are standard every month. Barriers to entry, really we can't control that, but industries that have high barriers to entry make more value in the business. The middle column are sort of neutral table stakes, if you will. These are expected to be present in your business. You should have some sales and marketing efforts and customer satisfaction. You should have quality human resource functions. The drivers in the right-hand column are table stakes as well that can hurt your value if they aren't present. For example, if your financial reporting or legal documents are not up to date and in good order, that can be a negative impact on your value. And we bring an owner-dependent business, as we're being an owner-dependent business, and we see a lot of this where the business is the owner. They just really own their job, and they don't have documented procedures. They don't have compliance with legal requirements. Their operations are a bit haphazard and only known to them. And so these are the areas that we really have a chance to increase value with is making sure that we shore up those items. And just to sort of illustrate that, just think if you had died 90 days ago, what would your business look like today? Many would be near worthless because they just don't have the documentation or the processes. They don't have people that know what to do, when to do, and where to do it. And so an effective way to help ensure the continuity of their business is in the event of an unforeseen tragedy is to properly document these things, to look at your buy sell and how well it's funded, to be able to protect your heirs. So when we talk about business value and succession planning, it's that notion that only 1/3 of business owners have a buy-sell agreement in place. And those that do, over half may not be funded properly. Talked a little bit about buy-sell agreements a minute ago, but there's some things to look at here with buy-sell agreements. It's has to do with succession planning and some other things, but we really need to be sure that they're reviewed. And we'll talk in a few minutes about the process of reviewing buy-sell and the funding process. So what goes into a good succession plan? We often see businesses that have a really good business and are running well, but they don't have any idea, what's going to happen. Who would be in charge if someone was incapacitated or passes away. So succession plans are important. It addresses who, what, when, where, why, how, and your professional advisors should be able to help you, with this, in the succession plan and customize it for your business and your goals and your desires. A good succession plan should address several points. Your goals, identify what you want to get out of the business when you retire. Your successors, who you will choose to take over for you, and outline a plan to ensure they're properly prepared. The ownership, the company will have multiple owners in the future. Specify the owner's roles and percentages. Management, define the steps that need to be keep vital non-owner management in place so they stay on board through a transition. Transfer, determine how and when a transition will take place and what needs to happen at the time. And then, of course, finances, identify where the funds will come from to buy you out. Calculate what taxes you do, and then be able to affect your personal estate. We also see a lot of this here that we're going to transition it to our employees. You cannot give a business to employees without a taxable event or even your heirs. So a lot of planning needs to go into that. Because it often saddles that next group with enough financial liability that the business either has to be liquidated or suffers. And the final thing that on the succession planning that we don't see, we see some of it, not enough of it, is to communicate that plan. Everything needs to be documented and communicated to the involved parties. We often just think that, we're going to die and they're going to sort it out, but that always has a bad result. So we want to make sure that in a documented plan, everybody's been briefed on it, and from the trusted advisors all the way to those that are affected by that decision. So we talked a minute ago, but any good agreement needs to be reviewed periodically. When it involves a succession plan, I would say a minimum of every 3 years, and more often if you have changes to the business. If you see significant growth, if an equity partner has entered or exited, you really need to look at that plan and have it reviewed and adjusted. 2022 Mass Mutual, that study, 1 out of every 2 agreements is in need of a review. Even things like change in family status. If we had a family member, a birth, a death, a divorce. We need to have a look at this, at our succession plan and even our buy-sell agreement. And look at the funding mechanism for that transition. Often we have put in place let's say it's a life insurance policy, but the business value has now outgrown those proceeds. We need to review that and make plans for augmenting that funding mechanism. There are some advantages to funding it out of life insurance. And we see a lot of that. The downside is that it moves the funding to now, but it does spread it over time. There's some disability policies that you could use in case of disability, but those are a little more specialized. We can talk a little bit about disability insurance. It does allow to specify in the policy what the terms of disability would be that would make the policy kick into place and trigger the buyout. And it does then take that decision out of the hands of the involved parties and puts it into the insurance carrier, acting as an objective third party to determine if the disability has occurred. Like I said, there's the cost, the premium dollars outlay have an economic benefit, but they're upfront, but it comes with a peace of mind that everything is in place in case something does happen, and you can focus again on growing the value of the business. So transitioning business ownership is when the owner is ready to retire, ranked last in terms of importance and priority. It's not surprising when you consider that nearly half of business owners surveyed don't think about retirement. I can't imagine ever retiring. However, more important than business owners, when business owners will retire, is how business owners will fund that retirement when the time comes. Less than 46% of business owners are confident regarding their estimates on sources of retirement income, and they claim to have a diverse picture of what income will come from. So it's important to understand and make some plans for that in the beginning.
All right, so the business value and retirement planning. This is the fun part for me because I truly like to grow your profits and your wealth. It's unfortunate that most business owners, according to, as you see on the slide, have less than $500,000 in retirement savings. And as you've heard from Ron, if you don't know the value of your business, you're setting yourself up to underfund your retirement planning. If you have someone who is honing in on building your value, and someone like me where I build your wealth, then you should know more. You will have a better understanding of your retirement planning. Go ahead and go to the next one. Okay, so business values and retirement planning. So another reason for underfunding retirement is when it's a lifestyle business, there's a lot of things that you don't take into consideration in your retirement. For example, a business owner is thinking that they're taking $100,000 from their business, and they're thinking they're going to need that in retirement. And that's what they're budgeting for, but not necessarily, because they're taking a $100,000 salary, and they're also taking $100,000 worth of benefits out of the business. It could be the car, the travel, meals, rent, a lot of benefits that run through the business that you will not have the business to run it through in retirement, and that needs to be taken into consideration when you're planning for retirement. So someone who's taking $100,000 in salary and $100,000 of benefits through the business needs to plan accordingly for retirement.
So when it comes to income replacement, as Diane said, got to determine what your consumption rate is, and just a very quick way to do that is to add up the income replacement value of the business, add the costs and the benefits, plus the salary and bonus, and divide by withdrawal rate you're comfortable with, and kind of figure out what that consumption is. But we often are a little bit enamored with the $1 million mark. But if, in Diane's example, you were receiving approximately $200,000 worth of benefits between salary and other things, and your consumption remains there, that $1 million would only last a little over 5 years if you had it invested properly. So calculating what your needs in retirement will be, and then that income replacement is essential in retirement planning, and not having a shortfall when you hit those retirement years. Because often business owners often realize that income replacement value is higher than what they think they could get for the business if they were to sell it. It means we need to augment with other things, but we still need to focus on business value. So when we talk about exiting in a business, there's a hierarchy of involvement. There's just exit with no ties. We sold the business and we walk out one day and we never return. We don't see this one a lot. We generally see, one of the other three act as a silent partner, meaning we've sold the business, but we kind of hang around. Maybe we receive, like a little bit of a salary or whatever, but we're still kind of there. The one we see the most often is, the two we see the most often is we exit, but we earn a consulting fee, which means we stay on the payroll. We're there to help mentor and consult. And this one is very difficult for most small, medium-sized business owners. That the business is their baby. It's a little bit like with your children. It's hard to let them make mistakes and to find their way. And so, but it can be done if properly documented and executed to remain around. And it can be beneficial for the business to keep that continuity there. The one that doesn't work very well is to stay active indefinitely in the business. This just means that I've transitioned ownership, but for all intents and purposes, I still control the business. The new ownership is really sort of prevented from making decisions and moving in their direction, and people still come to the old owner for all of the answers, and really does not bode well. So, it's important to have that spelled out before the business transaction happens, because if not, it can really cause us difficulty for the new owners to really create an identity and the value that they would like to create.
Now, the business value and your estate planning. Unfortunately, 2/3 of business owners say their business is, well, 2/3 of their business owners say that their business is their biggest asset, yet only 1/3 of them incorporate it into their estate plan. This could be a huge misstep if something bad would happen. And unfortunately, Ron, why don't you share that case that you had, that where it wasn't incorporated, there weren't any plans, and needless to say, the family was having to pick up the pieces.
So about 3 years ago, a friend of ours that we had known for about 30 years had a very successful business. At times it had struggled. About 3 years ago, the business was struggling, really kind of losing money. Husband and wife involved in the business. The wife more just, taking care of the reception duties and some other things. One of their sons worked in the business. But the real knowledge of the business and everything took place with my friend. He went in for a minor medical procedure and died. He did have a rudimentary will. He had a life insurance policy of about 1.2 million. They had a commercial property that the business is in worth about 2.5 million, had about an $800,000 mortgage on it. Their house is worth about 2 to 3 million, had about $1 million mortgage. And so the wife was left to pick up the pieces. The son was left to try and figure out the operations of the business. So we came in very quickly. Unfortunately, even really before the funeral, and just kind of got some information so that we could meet with them just days after the funeral to try and help them with a plan. So we recognized that the business had sort of two natural divisions of effort, and took a look very quickly. One of those was actually losing money, the other was making money. But the one that was losing money had a manager kind of over that division that at least kind of knew what was going on. We approached him. He was interested in buying, so he purchased that piece of the business out. In the meantime, we approached a mutual friend who agreed to give a short-term bridge loan so that they could make 2 payrolls, so that we didn't have a crash in business value while we were getting this lined up. Sold the business piece, essentially paid off the short-term loan with that, and then focused on the continuation of the business that was left. And what fell out of that is they didn't need the building anymore. We were able to contact another friend of ours who's one of the premier commercial real estate brokers in the East Valley. Came back in with a cash offer within a week. Within a month, the building was sold, mortgage was paid off. We banked the money, and we were able to evaluate her tax returns, and there was enough net operating loss from the prior 2 years that it covered, reduced any gain on the sale of the property, so there was not a taxable event there. We got her money invested, we evaluated. She wanted to remain in the home. They had one child at home in high school still. Wanted to remain in the home until the daughter had finished high school. So we crafted a monthly cash budget for her that would keep her in the home. And then the time the daughter graduated high school, she'd likely sell the home and then be able to have additional proceeds in investments to work her way through it. Final piece was I had another client in the exact same industry that volunteered to come in and mentor the son on how to manage the business, how to continue forward, and continue that mentor relationship for a period of time until the son was capable of doing that. Probably the best case scenario, given the circumstances, that had they planned prior, it would have avoided a lot of this. The documentation and the business would have been there. They would have understood first that one side was losing money and been able to take steps to alleviate that or to divest of it earlier. They would have had a clear transition plan of the business. As it turned out, then the son purchased the business from his mother. And we did just kind of a percentage of profits over a number of years for that purchase. That way, it helped equalize the effect to the other 3 children, getting a fair piece of the estate at some point. But had that all been outlined beforehand, it would have been much easier to just set those pieces in place, and so it would have saved her a lot of. Among the mourning and the heartache of losing her husband, she had to stop and divert herself into making these business decisions at a time when her judgment may not have been as sharp as it would be. And so we were very careful to help her through that. But it was something that really was kind of I felt bad for her because she couldn't properly mourn. She had to stop and do these other things. And so it's just a real key to have these things in place prior to an event.
Go next slide.
So with that, here's some of the steps that are important in that process. Estate planning really involves sort of 4 areas, and that's estate reduction. That's gifting business ownership while you're alive to pull it out of your estate. This is generally handled in a trust scenario, but this is where a lot of the planning comes in. There's estate liquidity. That's making sure that the estate has enough liquid assets to pay any debts of the estate, including taxes, and without having to liquidate the business assets. Estate equalization is creating a fair environment for all family members, both those working in the business and those not working in the business. And that might mean that some children get a larger interest in real estate or other assets and no interest in the business. If possible, you want to avoid family members that aren't working in the business from having a very large stake in the business, because they can hinder, the growth and the operations of the business. I did have another one that happened to a few years ago. 4 children, 3 were active in the business, 1 was not, was a bit rogue, but they were all given equal 25% interest in the business. And even though the parents' wishes were documented in how to buy that child out, they refused and drove the price higher to get out. And it took about 4 years of really stalemate in the business and being able to grow it and to move it in a direction to be able to get that other child satisfied and moved on away. And it caused some very hard feelings among the 3 that were in the business. So planning beforehand, is really important. And then the business valuation, how and by whom, and will be business be valued at your death, because there is an important date at the date of death, and that's the value at the date of death is what the estate is valued at, and that's what the tax is calculated on. So there is an alternate election to be able to value it 6 months later if there's significant event that changes that value. But you wouldn't elect it if the value went up, and only elect it if it went down. But those are the 4 areas that you really need to concentrate on when it comes to estate planning for business owners. So when it comes to the liquidity in an estate, there's certain sources of funds, but we should view the sale of business assets as a last resort. We've all heard horror stories of people who have had to sell a business or a family farm to pay the estate tax, and so we want to line up our planning to be the last resort, because the executor of the estate has to pay the debts of the estate and wind the estate up, and then distribute anything left to the heirs. And we want them to avoid sort of a forced liquidation, which really brings minimal value for a business. There's ways to avoid selling the business, but they're very risky. The executor could elect to take a loan inside the estate to meet some of those obligations, but then that brings up a whole issue of additional problems. How does that loan get paid off? It has to be paid off before the executor can wrap up and distribute assets to the heirs, and so we're trying to avoid that one. And then how do you find the liquidity to pay that loan off? However, that same Mass Mutual survey said that 13% of business owners would expect their estate to have to borrow money. But not a good result. So the final piece that, we find is very effective is to fund the estate with life insurance. But you have to be careful here too, because you don't want that life insurance value to be included in your estate. So you need to have some attorney help here to have an irrevocable life insurance trust as part of that, so that you can avoid that being in your estate. And there's a lot of other pieces that go into that kind of beyond our discussion, but life insurance is a very it spreads it over time, and you can adjust it as needed to meet the needs. So less than a third have an estate equalization strategy, and most plan to divide business equally, which would move the children into business and out of the business to get the an equal share, which we mentioned a few minutes ago. That may be equal, but it's not necessarily fair. And so the equalization in an estate needs to look at all the factors and see, how, best to make it fair. But in doing that, if you move business assets to one child and say more liquid assets to another, it may not seem fair as well. And it's because they get liquid assets and another one doesn't. And so you really have to be carefully planned in this. But it all just comes down to planning and knowing the valuation. We just covered most of this, differences between liquid assets and illiquid assets, and distribution of business and non-business assets, and then the timing of those distributions is important. And then, there's some paradigm shifts, but in conclusion, I just want to kind of reiterate that, we want to look at a business valuation through a different lens. It's not just about knowing the value of having the numbers, but rather understanding the what drives that value and why the number is what it is, and what creates that and how we can change it. And we should try and shift our focus from being a current income and more focused on value. And the things that drive value typically will then drive income. So we just don't want to have a business that maintains our current lifestyle. We want to be able to plan for the future. So, and finally, we want to make sure to include some experts in these things, those that value business, those that can help you create a plan, to increase value, those that can help you create the estate plan. So we encourage you to take a look at it, to think about it. I know sometimes we don't want to think about, our own death or the eventualities, but it really is something that's necessary for us to focus on as business owners to move forward. So that kind of concludes. We have a few minutes for questions if anybody has any.
Yeah, this owning your own business, this is not the most exciting part of owning your own business. And like Ron was saying, your business is your baby, but knowing the value is so impactful. And then also incorporating these tax strategies to really build your wealth and taking advantage of the time value of money in the market is huge. We didn't touch on that. That's a whole other discussion. But building your estate through your business is ultimately what we wanted, and it's not the most exciting part of growing. So thank you, Robert, for allowing us to be here. Go ahead, Ron.
Dan asks the question, would I need to hire a CPA to value the business? It depends on if that CPA also carries a certification from evaluation. We recommend that you find someone that is a certified valuation analyst or a senior valuation analyst, someone that has been through the certification process for the principles of valuation. And there are CPAs that carry both, and there are those that who just focus on that. So we encourage you to find, we have some people we deal with and can recommend if you wanted to contact us offline.
Excellent, great response. Any other questions? We've got a few minutes that we can do questions before we wrap up today. And you have Diane's contact information there on the screen. And I believe Ron's is in there somewhere too.
Do you want to show the QR?
So we have an offer, a special. We've created some appointment times over the next 2 weeks where we will have an hour and maybe a little more strategy session, complimentary strategy session with anyone that's in the today. If you click on that QR code, it will take you to a calendar and can schedule a time. And once you're in that session, when we have a strategy with you, if you decide that you want to move forward, we have some significant discounts that we will offer at that point for our services.
Robert, can I put my Calendly link in the chat box?
Yeah, absolutely.
All right. And I also throw in my LinkedIn if anyone wants to connect.
Excellent. Well, while Diane's doing that, we want to thank everybody for joining us today. We want to thank Ron and Diane for this session on value and the importance of it, and the planning ahead of time and how that can impact your business when it comes time to exit, or whether that's planned or unplanned. So again, thank you. We appreciate everybody being with us. You have their contact information, that no-cost consulting session, the QR code on the screen. So hopefully this was beneficial to you. We did record it, so if you want to go back and review it, it will be in our content library in a few days. With that, again, we want to thank Ron and Diane for sharing their time with us. And we will see everybody soon. We hope to see you on Tuesday's boot camp. Until then, have a great rest of the week and weekend, and we'll see you soon. Thanks, everybody.
Appreciate it.